Hello and welcome to our final monthly trade floor video for 2020. I'm Hugh Holden and I'm joined today by Portfolio Manager Rob Mead. Rob, we've recently received some positive developments on the vaccine front, which has led to a bout of optimism and also a bout of discussion around inflation expectations. So what are our latest views on inflation over the short and longer term?
Yeah, it's a great question, Hugh. And as you know, PIMCO for literally a decade or more has rarely used the word inflation because it really hasn't been relevant for our investors, for our portfolios. But from our secular forum last month, we first time in almost my memory of PIMCO, we started to talk about inflation, but we still see it as being a sort of 3 to 5 year event away from here. It's not something that we should be overly concerned with now. I guess the factors in terms of how quickly inflation could appear will be partly as a result of the combination of vaccines, as you mentioned, plus fiscal policy. So to the extent fiscal authorities retract or pull back in terms of their stimulus, inflation will get pushed out even further. I guess the other thing to bear in mind is, as a bond manager, we have plenty of tools when that day eventually comes. So whether that be investing in index-linked bonds, TIPS, things like floating rate notes, or even investing at different parts of the yield curve to acknowledge that the front ends will remain anchored, whereas the back end would be vulnerable in an inflationary scenario.
And sticking with the vaccine news, we've also seen equity and credit markets rally off the back of that positive news. Credit being a sector that we've viewed as quite favourable in recent times, how do we now view the valuations both here and overseas?
Yeah, you're right, Hugh. Credit spreads have rallied a lot from their sort of March, April wides, but they're still, in many cases, not as tight as they were at the back end of last year. Remember, we've also seen a fundamental improvement to the extent that economies are recovering. So there's a lot of justification for spreads to be tighter. I think the really important thing, though, is within the investment grade space, we're still very well covered for defaults. So we're not concerned there. And there's also a lot of dispersion that's remained in terms of the haves and the have-nots in the credit markets. So there's plenty of opportunities to sort of actively choose underlying credits. Final thing I'd say is there's still some pretty interesting and compelling income opportunities. So from sort of very high quality global credit in that sort of 2 to 3% range, further down the curve into more liquid securities still offering high single digits. So depending on investor risk appetite, depending on overall portfolio construction, we still think the credit market provides a compelling source of income.
Okay, and then turning to focus more domestically now, given increased spending levels, do we have any concerns around state government fiscal positions or potential downgrade risks?
Yeah, we've had as you know, we've run an overweight to semi-government bonds for quite a while. And given the fact that their debt levels are increasing, and also given the fact that their spreads have tightened dramatically, given some of the RBA announcements, we have been trimming that overweight. We're probably running one of the smallest overweights we've had to the semi-government sector for a very long time.
Okay, and Rob, now final question for what's been a very unusual year in 2020. What are your key takeaways for investors to consider as we begin to look forward to 2021?
Yeah, it sure has been an eventful year, to say the least. I think they're looking forward. We think cash rates are going to stay very low for a long time. So investors should be thinking hard about sitting on any lazy positions in portfolios. There's plenty of things to do without being bogged down in a negative yielding cash rate. As we said before, there's still plenty of opportunity in the credit markets. So be selective, but we think we should be an overweight there. One of the things we talked about a little bit earlier here was illiquid credit. We still see a very significant opportunity there, probably better than we've seen for a decade or more. So putting all these things together, we still think there's plenty of ways for investors to outperform inflation, to outperform the risk-free rate, to have a very diversified portfolio that should have a healthy dose of bonds in it. And we're looking forward to making all those active decisions again in the coming year.
Thanks, Rob. And thank you for joining us. And more importantly, thank you for your support throughout this year. We really do appreciate it. If you have any further questions or would like any more information, please contact your local PIMCO account manager or visit our website at www.pimco.com.au. We really look forward to seeing you hopefully in person in 2021. And for now, on behalf of Rob and the rest of the team at PIMCO, happy holidays.